today, now interesting enough, we've got a new guest speaker over here. Now, before I introduce him, I just want to give you a little bit of overview on the purpose of Live Trading Workshop. Now, Live Trading Workshop purpose is to give you the truth of trading by interviewing top traders who trade for real and give you different perspectives to trade the markets on the smart money framework. We also interview partners like brokers, software providers, etc. from time to time who can give you the necessary support to overcome the obstacles you have in trading and help you achieve consistent trading performance. So today's speaker that we have is Yannis Kantatasis. And Yannis Kantatasis was born in Ottawa, Canada, and grew up in Thessaloniki, Greece. He studied economics at the University of Macedonia, Greece, and graduated in 1994. He obtained his master's degree, Master in Money, Banking and Finance from the University of Birmingham, UK, as well as a diploma in Political and Economic Studies from the Universitat Autónoma de Madrid, Spain. He holds all relevant professional certifications and qualifications, including options market making. He has over 25 years of experience in investment banking, both in Greece and the UK, with an emphasis on online trading, covering a wide range of financial instruments such as options and futures, CFDs, FX, stocks, structured products, ETFs, commodities across global markets. Lastly, he's an associate member of CISI in the UK and sits on other financial committees and clubs in Greece, Spain, and the UK. He speaks fluently 5 languages and is passionate about traveling, art, and music. He plays the piano, and while lecturing and teaching his favorite subject, options across the globe. Yannis, welcome to Live Trading Workshop.
Thank you very much, Thiru. I couldn't have said it better.
I know it's quite extensive. I was smiling to myself because there's a lot of tough words over there, especially with all the Greek names and the Spanish names. I was really put to the test over there. But hopefully I got there. Okay.
You did. Nailed it.
Great. Yannis, we've known each other for a very long time, so it's really nice and a pleasure to have you on the show, to interview you today. So before we get into the nitty-gritty and all of that, I thought we would just start off with something quite mild and start going in a bit deeper later. So tell us a little bit about your background, Yannis. How did you get into the world of trading? I mean, how old were you when you started? What event triggered your interest? And do you do other things with trading, or is it just full-time?
Well, I have to go back about 25 years, 26 years, I think. So it was 1998, and I joined a brokerage in Greece just after the army, which is compulsory for us. And I was young, like 27, 26. And you get to know how everything works, back office, settlement. At that time, nothing was electronic almost. We were still trading in papers. The stocks were in paper form. And quite different. We're still in the era of open outcry, for those who know, and you could still buy and hire a place in the stock exchange and do the brokerage business. And then came the internet, and everything changed. So I spent about 6 or 7 years in Greece, working for 3 companies. One of it was in the private banking sector, one of the biggest, and then caring for portfolios. So I started my career as a portfolio manager. And, little did I know that options would be making 100% of what I do 30 years later along the way. So I met options in 2000 when they were introduced in Greece, in Greek market. And it was a shallow market. So we started trading a couple of companies only there in Greece at the time. And, gaining experience in servicing clients, sourcing them, selling, and all that. And in between, I just decided to take advantage of my language skills and then moved to London in 2006. Started working for CMC Markets. For those in England, they recognize it's one of the best spread betting CFDs companies. So I, together with my team, because running a part of the institutional team at CMC Markets for about 5 years, not from the beginning, but soon after. And then we opened the market in Greece, in Spain, and Latin America. So bringing CFDs into people. That lasted about 5 years. And then I have been trading and training people to trade and use leverage products. It hasn't always been an options. For example, CMC didn't offer options, nor did FX Pro, as I saw you use FX Pro's platform. So I did a stint for a year in FX Pro, and then jumped to Citi. So I was at Canary Wharf, second floor trading, one of the 945 trading positions, as you know. And this is where it all kicked off. Really with the nitty-gritty of options, because we were doing structured options for hedge funds, and with a focus on foreign exchange. Yeah. And so up until today, I came back to Greece in 2014, late 2014. And whatever I was doing for the institutional world in different languages, I came back and continued, if you want to do it, to retail clients, smaller or bigger, it doesn't really matter, across the globe, I would say. And I keep giving lectures, different events. I'll be in London, for example, for the finance magnates in November. I'm moderating a panel. I'm in another one in Athens, just came back from Spain. So it's always interesting. And I always speak about my favorite subject, which is options. So it's been about 26 years of myself, battling with the markets and with myself, psychology and everything else that has to do with a successful trading. Hopefully I came across options quite early in my career, and that has helped, shape my way as an investor and trader. And I guess I'm here today to show a little bit of that 26 years of experience, together with all the mistakes that I've amassed ever since.
Interesting, isn't it? Yannis, the journey always, of course, mistakes always follow us because we can't become then the person that we are, as long as we see mistakes as a stepping stone to become the best version of ourselves. I've always heard that from lots of traders, including our journey of a trader. I think the principles are always, and there's some similarities always, isn't it? So that's amazing hearing that. 26 years of shaping yourself up. I mean, one thing I was curious, a nice journey. I mean, all the events that then sequential events that triggered your interest, and working at CMC, FX Pro for a little bit, going to London. It's quite a bit of journey there. One question I will ask you on that before we go into the technical side is, what finally triggered you into options? Because, the conventional, what we hear in the media is usually on, futures or, on spot, or the conventional way of trading on swing. But what triggered you into options? What made you go into that rather than the conventional side of the other part of trading?
Well, you see, that was kind of a luck in terms of how important these things I realized they were right from scratch. Because otherwise, learning options is a journey, right? Because you've got to get your puzzle together, and you have various factors affecting an option of the pricing. And people would start with hedging. We start thinking about covering the positions in case things go bad with the markets, and then employing more and more strategies. So I was lucky enough, there was a guy in another company and in my company at the time in 2001 or mid-2000. And believe it or not, we were doing arbitrage on the Greek index. So there was such a shallow market. And then with the introduction of new products, very few people knew about options. And there were actually two banks and one brokerage. I was working for the brokerage, and the two banks had brought one of the guy, a Greek guy from Canada. So I was born in Canada, like you said. A Greek guy from Canada comes, he's, the guy, the star trader option, the Nick Leeson in my eyes. And I'm like, we're here now, we play. And then for about 12 and 15 months, we were able to roll positions and have an arbitrage on the Greek index, making about 47% a year. And then I just realized all of a sudden at the start of my career that it's not only buying stocks or selling stocks or trying to find the timing, which, 26 years later, I came to understand, and I teach that first and foremost, that it's not about the timing, but for me, it's about the time in the market. So we were making money doing absolutely nothing, just taking advantage of the option chain. So something was more expensive than it should be. And then that, because of the theory, comes eventually to the price it should come. That is called arbitrage, because you're buying an index and then you are selling the derivative on that index. So it's the same product with different pricing, because the option product has a time value element in it. So I came to find out about the power of options. You can do things by acting smartly. You don't need to actually, guess where something is going. You can actually say, I don't want this product to fall between or below a specific price. But that arbitrage thinking lasted only about 12, 15 months, because as many and more players come into play, you can understand that all the margins, like high frequency trading, they get diminished quickly. But that was, the kickstart of my career in options 24 years ago. And it really hit me. I mean, how can there be a product that no one knows and it can make you money by being as safe as it gets, right? Because that's what arbitrage is, more or less. And then with the years, you get to know the different strategies, you get to understand psychology, you get to understand, what are the mistakes that other people make. In essence, 95% of people do the same or make the same mistakes. And then you have to be with the 5% of people who don't. And these 5%, they use different things, different strategies, different tools. They don't go by the book, and so on and so forth. I mean, we will discuss some of these today, but that's how it started. So it wasn't the hedging, and it wasn't the leverage, and it wasn't something like a friend said or told me. It was the start of this fantastic product in Greece. And I was lucky enough to have that great guy who was trading options for all his life in Canada. So there you are.
Interesting, isn't it? How it all came together, because the guy was also the same as you, right? From Canada, and he's a Greek as well. I mean, what's the chances when you
Only
really
smarter
look?
than me. The guy was smarter than me at the time.
At that time, right? We always need a mentor, as we always say. So yeah, it's interesting how it all comes together. It reminds me of the stories on how I met my mentor as well. Interesting how the sequence of events and the intelligent orchestrator up there actually orchestrating everything. In any case, so if we go a bit then deeper into your style of trading, so you mentioned quite a few stuff. So you talked about the options, the arbitrage, mean reversions. So what is your style of trading really then, Yannis? Are you more like using options still with the basis of swing trading, or scalping, position trading, arbitrage, mean reversion? What is it?
All right. So that's an interesting question, and a very long answer could be due. But to cut a long story short, my idea is, it goes with age and it goes with the experience. With age, I mean, I'm 51 plus, and I trade like I was 30. They call us boats burn out at 30. So I can't trade the way I was trading at 30. So the moment you grow up and you have kids and you've got other priorities in your life, you want to take yourself away from the screens and devote time to do things that you really love. So I need money to buy me time to do the things that I'm more interested in, right? I love my job. I love teaching people. I love trading. And then I had to bring that into equilibrium. And that has led me to applying and teaching strategies that don't go on the scalping side, on the intraday side, no matter how good these things are. But for me, the swing trades that you mentioned using options are most, they apply to the way and the style I like to have.
Interesting. So it's mainly on the swing style of options that you are actually looking at. It's what I think we a little bit discussed this one. That's why we looked at the smart money framework that we have designed as well. Very interesting. So so you're not really doing much on the arbitrage or mean reversion. Is that right? Or do that sometimes come into play as well?
No arbitrage, because I don't have the tools now, as the markets and the high frequency trading with machine learning and all that has taken off. And that was just, the beginning. But mean reversion, yes, because mean reversion, the way we do is that we sell volatility using options. So we take a stance against another line that it won't move that much, or even if it does, it will land in between two strikes. That's actually based on mean reversion, because things in the stock exchange do not go from A to B in a straight line. They go like that. So that is a mean reversion, and you've got the probabilities on your side. So all it is for me is I'm having a risk-reward ratio that is quite favorable when I'm taking, defined risk positions, or when I'm selling volatility and taking a stance against a specific movement around the strikes. then it will have to be a mean reversion idea behind it, which it is.
Got you. Interesting. Yeah, I'm a little bit on mean reversion. One of the edges of mean reversion is really how you calculate the mean, which is what you were really touching upon. Now, going a bit deeper into on your type of entries and based on your concept of your trading in terms of swing trading, is that like a concept to all the trade setups you take, and what does your typical trade entry look like? I mean, feel free to share the screens if you want to as well.
Yeah, okay. So I think best to describe using an example, a live one. So I hope you can see my screen, and this is it.
It should come live in a little bit, I believe. Let's see. You've already shared your screen, right?
Yes.
So there we go. I think we can see that right now. Awesome.
Okay.
Yeah, go ahead.
So I don't want to get into many technicalities because I'd really like for people watching today to understand why options are so powerful. Now, you can learn the nitty-gritty and read a book and attend a seminar, preferably mine, of course. And it's all about opening your mind and thinking, okay, so if I'm trading intraday and scalping and everything, it's not for the faint-hearted, I'm sorry, but you could be making money, but then, giving away some things, perhaps time from your loved ones, perhaps a little bit stomach aches, and I don't want that in my life. And then I found the sweet spot and the strategy that I will explain now in terms of you don't need to be glued on the screen. You don't need to be like 5 hours watching the market in the evening, because I trade the US options market. So Greek time is 4:30 to 11 o'clock. I can't imagine myself being in front of the screen for 4.5 hours, try to squeeze out, the next position. So the way I have to do it is think, what is it that the majority of the people do? The majority of the people, they try to get certainty in an uncertain world by definition. You can't have certainty in this uncertain world. So you try to think where, for example, SLV, which is the ETF for silver, and you think it's going up. And the majority of people will be trading using technical analysis, fundamental, whatever it is. But at the end of the day, they have a binary bet. It goes up, they make money. It goes down, they lose money. And then there is no way, if you don't use options, there's no way to escape from this unless you start your DCA, like dollar cost averaging. The more it falls, the more you buy, or you do your volume weighted average pricing, the VWAPs and things like that, which is okay if you have a long-term portfolio, 5 years, 10 years, and you like the stocks that you've monitored, and you want to buy Apple now and Apple next year and Apple 2 years from here. And you were buying Apple 10 years ago, just like the example with the gold that you presented. I mean, I like to own gold for the rest of my life, and I've been owning gold for the past 27 years, and that will not change. So if I want to buy gold in a certain manner, it's okay to do DCA and your VWAPs, and long term, you get through the waves. The problem is, like Kane said, in the long run, we're all dead. I'm not sure how long I will live to enjoy all the money that I'm making if I'm successful as a trader and investor. So along the way, I have, in order to get the overperformance from what I just said, like buying and, whether it's Bitcoin or gold or whatever, I have to go through the short-term volatility, the short-term spikes. And these are the things that kill us. The August, I think it was a Monday with a yen carry trade, and then stock markets open -7, and that got killed many people with the meme coins and things like that a couple of years ago, where hedge funds got depleted. And then you've got COVID, of course. You've got 2022 bear market, a very long bear market in our eyes. So how can you fight these things? And I came to understand that if the majority of people use tools to go on a binary bet, I have to go on the other side and act like the casino, act like the insurance company, and use products to trade the options market, which is this thing here. You don't have prices because markets open in about 35 minutes, but we'll show the main ones. So if I have people, they have an appetite to speculate on something. So what would they do? Well, they would use options to exploit the leverage, because options gives you the ability to leverage your investment. And they would use it badly. How? Well, they say instead of 5,000, I can get an exposure for 100,000. So let's buy some options. But this is still a binary bet theory. It doesn't change anything. It only makes it worse, because you have a 50-50% probability to make money. Up, you make money. Down, you lose money in the short or medium term, right? So if all of these people chase the smaller out of the money options, they take bets, risky bets with defined risk. That's the key here. So it's like, playing or placing a bet on football. And you will say Chelsea against Tottenham, I don't know, and 2-1 or 2-0 at the end of the match. Perhaps William here will give you 1 to 2.4. You bet 10 euros and that's your maximum risk. That's exactly here. You can use options wrongly enough, if you ask me, but you can use options, and this is what 95% of people will do, to make it as a bet. I can bet X amount of money, $100, $200, it doesn't matter. That SLV, which is silver, will go up. If it doesn't go up, I'm only losing the bet, the $100, $200. That's fine. Well, it's fine by you, but the problem is you're losing 9 out of 10 times with this, unless you are excellent stock picker, excellent in your timing, and then you have, pretty much quite a few qualities that the average person will not have. And I'm thinking, if 9 out of 10 people will be trading these lottery tickets, which that's what it is, they're lottery tickets, right? Why am I not doing this game as the casino or the insurance? What are they doing, these guys? And the casino, in terms of, perhaps the American roulette is an example where you got the advantage as a house, as the casino is always 5.4%, the statistical edge that you have. Why? Because you've got the 2 zeros, 1 0 green and the 2 zeros green. So there is no way in the long run that the client can make money. The casino will always make 5.4%. So $54,000 for every $1 million traded. Okay. So if I can use options to sell volatility, so have a position, and I will show how this is done, and make a little bit of money every single day, so to speak, not aiming for lottery tickets, and making consistent income. I'm not calling that passive income, but it's consistent income. And that's what the casino does. They don't care if you make money or the guy next to you wins money, right? Or loses money. They care about people trading a lot so that they can make 5.4 because they've got the statistical edge. That's the edge we are making as option traders. Insurance companies bet on making 99% of the premiums they collect, and then there's 1% risk that your actuary will tell you how risky is that, and you get to pay your client, right? So that's what we do. We collect 99% of the premiums that the clients, retail clients, are happily paying us because they go after the lottery, and we collecting these premiums on and on, on and on, and we know the risk of the 1% is going bad, and that's what you hedge at the end of the day. All right. So that's the idea. And the reason I'm doing swing trades, so my trades last about 2-3 weeks, perhaps 4 weeks. They rarely go beyond that. I'm talking about options, right? Because in a portfolio, you've got your stocks, your Bitcoin, your whatever other exposure, and there might be like 2, 3, 5, 10-year horizon trades. But you have to hedge your short-term volatility, your statistical noise, and that you can only do with options. And then options, because you've got volatility, time, pricing, you've got all these elements combining together. This is what they call them, a science and an art at the same time. So what I would do, it doesn't matter how it is called, but to answer your question, finally, it would be, say, if I think, let me go to a chart here, for example. This is Interactive Brokers, by the way, right? So you can do 56 different strategies with options. They're called plain vanilla options. And then the ones that we were using as City, like I told you in Canada, that you don't even use those things. You go beyond and you start using knockouts and accumulators and things like that. And then you go beyond structuring the trades. For us, plain people, 56 strategies is a lot. I use 7 or 8, and I typically use about 4 or 5. So once you get a method, you won't exercise that method, right? So if I take SLV, it's a volatile instrument, and I've run this channel because what I did is not like selling premium and hoping to get the premiums for the guys. Here, I did something that had a defined risk, and it was betting on the upside. But betting on the upside with options, Thiru, you've got a defined risk, and you've got a risk-reward ratio like 1-4 or 1-7. That trade on the SLV was something that was risking $200 and allowing you to make $900. And these are the type of trades I like. Now, they're quite rare in terms of like, you have to get the timing right. And this is not our bread and butter. Our bread and butter lies, for example, in an instrument, say, we trade a lot of ETFs. Perhaps I can take XRT. So typing here an Interactive Brokers XRT, it can tell you it's the retail ETF. And why am I choosing that? Because the breakout, I think, for the S&P reaching eventually 6,000 points, which I think it will end up there, but it still owes us a correction, perhaps. So the retail ETF, it shows the appetite of clients to buy things, right? And when do you buy your second Louis Vuitton or your second car, or you spent on the 5th Cuban cigar for the weekend? When you're not worried about how the economy will be faring. And this is a very good indicator. So if I go on XRT, and because I don't want to start doing guessworking, I can see XRT, and I draw the channel. A 5-year-old guy can draw this channel and say, listen, up and down, wave up, wave down, wave up, wave down. This thing is going within a channel since April 24. The moment it breaks on the outside, that's a different ball game. It did it like 5 times, but every single time it's proven a false breakout. Okay, simple as that. Elementary technical analysis. I don't do a technical analysis, but a graph, it can help you. So I can do this thing and think like between 79 and 71, it's pretty safe to say that this will be moving in the future. Okay, if it breaks above 79, it means markets are going crazy. S&P goes to the roof through 6,000, and then you don't have your stop losses, but you've got your options risk management. Now, the difference here is I don't take like the moving averages here and say, oh, we touched this moving average, which is the green one is the 50-day simple moving average. By the way, I use simple moving average like the hedge funds, I think, because I don't see a reason why the latest observations should be bearing more weight than the observations in general, which is what the exponential moving averages do. And XRT didn't break out. So I would go here. Instead of thinking, well, if I buy here and some more here and some more to support, I'm going to give here XRT a graph, so strategy builder here for Interactive Brokers to show me the pricing. I'm not going to have prices, but the idea is, first of all, options have an expiration date. It's not like stocks that you can buy them and hold them, till death do us part. So you have to choose an expiration date. For me, because we're talking about swing trades, the expiration date is on a regular 3-week expiration cycle, or the closest to that. And that would be a minimum 45 days up until 60. So if I choose December 20, you've got 58 days. Now, it's not ideal because, you pay for a lot of what we call time value. Okay, because, that option will be of greater value because there is more time into it to prove that you are correct with your position. That's why it's more expensive. Now, I can choose between 45 and 60 days to expiration, and then the XRT is trading around here, 76. Again, I don't have pricing, but the way I would do it without even taking a look at the chart, I will tell you. I work a lot with the standard deviation. So, the Gaussian bell-shaped distribution, Gauss didn't invent it, but he did improve it. And the standard deviation. So one standard deviation, so you've got the mean, and then you got the deviation from the mean. it's 68% of the times that you will get it right. One standard deviation, you can take a look here, IB actually is giving you, if I move on the pricing here, you can see here, well, one standard deviation is the 84, around 83, 84 strike, okay? But you can calculate that. But say IB is making your life easy. Why one standard deviation? Because one standard deviation will give you enough room for things to go bad and still have 68% of the chances to make money. Why? That's where the mean reversion goes into play, Thiru. Because if something goes up, like here, for example, say you open the position here and that thing went up, it went down again, and it's been doing that for months and months. So the more likely it is for something to go mean reverted, the further you have your strikes and you have higher probability of making this trade happen. Now you got your calls and your puts and the put ops in the options. And one is betting on the upside, the other is betting on the downside. But the way you would use it, like I said, we are selling volatility. We are selling the dream to the guy who wins the lottery or who wants to win the lottery. He doesn't win, right? So 9 out of 10 times, and I'm not talking about a day or 2 days or 2 hours, because we want the option to sell something and keep the premium in our pocket. The other guy strives, he bought something and he wants that premium to multiply. I want that premium to die a slow death. And in order to do that, I'm selling volatility. Now, one good thing, Thiru, is like I told you, trade what you see. Implied volatility, which is what traders think volatility will be, how expensive they think this ETF has or will be, is overstated by 75% of the time. As in 75% of the time, that implied volatility that traders think is not going to be that much. So effectively, you are selling something that is more expensive than it should be. And this would 8 out of 10 times go back to where it should be, where the historical volatility, the average mean is. And that's why we're selling premiums. We are selling something that the 95% of the traders who buy it they push the price higher. And then because they don't know how to trade options, they buy the cheap ones. The cheap ones is a very low probability trade. So 9 out of 10 times we'll be losing their money, which we make on the other side. And we have to manage our expectations because the risk is very big when you're selling volatility, which is what we do for a living. So what I would do is just sell the 85 if I had prices, and then I would go on the call option and find the other standard deviation on the other side, and then go on the graph. So this is a 69. So selling both things. Interactive brokers will not sell anything. They just bring down here the position. And if we had prices, I would have a mid price, and then I would be able to execute. And clicking profile, they will give you the type of strategy that I've done. That's called short strangle. It doesn't matter. They have found funny names about that, but you would get a graph here with probability, etc. And you would find that the profit probability is always 75, 80% upwards. So that's the graph. Okay. So you have an 80% probability of making money with such things and only 20% of losing money. And the bad thing here is that you're going to lose a lot. It's not like a defined risk. You're going to lose a lot. And that's what scares people of doing this. And if you got scared by watching a short strangle, there are ways to limit your losses and obviously your gains. There are ways to make you sleep better.
Interesting, because that's the part where we want to talk about in the risk management section, isn't it? Which is how do you limit actually the risk? But before I come into that, Yannis, I think thank you for that extensive, detailed explanation. I think that's really good. Just for the guys who are not have done options, just a small question so that they get a perspective. So you've explained a little bit on how you would look at your trade entry and the channels and the graph representations and diagrams. That's a very small question. Do you scale? Is there such a thing as scaling into your trades in options? And would you say that? Is there such a thing?
I wouldn't do that. because when you decide to open a position, you've got 30 contracts to execute. You don't know, because you've got two options entailed, right? You've got a call option and a put option. So if that thing goes up tomorrow, one of the options will be losing, the other will be making money. And at the end of the day, you will be having the same price. I have empirically seen that, yes, 3 out of 10 times you could get better prices on your entry levels. Say, I want to sell something for one, and then within a week, it gives you the opportunity to also sell for 130, 140. But 7 out of 10 times, it doesn't. It goes straight away from one downward, which is where I make money. So I always advise 80%, do it right and then leave 20% to do it either on worse prices or better prices. But one thing, Thiru, before you go, if I open the chart and I can show you here that I chose the 85 strike and the 70 strike on the chart without knowing, right? See how important statistic is. The 70 strike that I chose happens to be below the 3 lower levels. It doesn't happen to be, the standard deviation will show you that exactly. So effectively, I'm protecting this level here. Below this level, I will start losing, and above 85, which you can show here, I will start losing. So there is a $10 window before I start losing towards the upside, and a $6 window before I start losing to the downside.
Right.
You can see I've got a $16 move up and down. I don't care, where I can make money. So if the stock goes up, I make money. If it stays the same, I make money. If it falls even by 10%, I make money. How can you do that? By trading shares directionally. You can't. And I didn't take a look at the chart, right? So that's what the standard deviation and the bell-shaped distribution with statistics show behind the selection of the strike prices.
Interesting. Yeah. Thanks for pointing that out, because that really clearly defines the edge of options trading as versus directional trading. Just on one last question on entry, I mean, is there like a best trade to date so far that you can think of, and what was your thinking behind that entry?
The SLV, you mean, or the XRT that I'm showing here?
No, just your best trade to date so far in your whole. Yeah.
I can't qualify something as a best trade. So my best trade was Alibaba, because I bought a 70 and just sold 115 a few days ago. So I made 50% of my money just by buying the stock. But if you ask me about options trading, I would tell you I've got too many best trades, because we make 8 out of 10 trades because we're selling volatility, and then we aim at making a little bit of money, but all the time. And this strategy is like giving you the best trades to make money. I cannot make 1 million or 100,000 if I wanted with this strategy, because the maximum I can make is the premium. So every time the premium is multiples of 100 or 200s. And every time I have the method that I sell X amount of option contracts. So every time I will be making X multiples of $1,000 Ethereum. So that doesn't change. It's not like once I made 1,000 and then next time I make 5,000. I can't. I will make $1,000 every single month, bar any exceptions. So I can tell you many things about my worst trades, that yes, but the best ones are like categorized as my 80% plus hit rate that this selling premium strategy is all about.
Interesting. Yeah, thanks for sharing that. Alibaba, that's interesting. All right. And in terms of risk management, yes, so let's come to that. And you talked about the straddle, you showed that people get scared about the downside of the options. So tell us, I mean, especially for those who have not traded options and are quite used to thinking of the conventional way of directional trading. So do you guys use stops? If you do, where do you place them? Or what else is the concept of risk management if you do not use stops?
Okay. So I've got to go a little bit into technicalities, but just a little bit. Now, you have to think that we are doing these strategies and then thinking that something will move in between two strike prices, like the $16 range here, right? So you have to understand that markets will go up and down through, and they might breach either of your sides, right? So here they could go to 70, go to 60, and they go back to 70. And I'm mentioning that because some people go, bananas when something goes below 7, and then straight away they close the positions. This is exactly where our statistical edge comes from. It will go back into the levels that you chose 85% of the times, period. It's just playing with your psychology, right? Because here you're panicking. Here you're saying, oh, Armageddon is right knocking on my door. This is going south. And the moment you close your position, that thing goes back in the range. Why? Because of mean reversion. Because if from the $80+ it went down to 70, and you haven't chosen like the Teslas, the Netflix, or the Nvidias of this world, because they go up and down like crazy. So perhaps they are not the candidates to sell volatility on, because when you sell volatility, you want things to be calm, more or less. So if something goes south, it has lost 15%. Now, you know from experience, when something loses 15% and you are not on a bear market, because obviously 2022 was a difficult year, then that thing 80% of the times will go back in. So you don't have to do anything. And that's the idea behind it. So the risk management, you wait for the convincing pricing of the breakouts of, the break-even points, right? So this break-even point is around 68 here and 86 up there. That's your break-even points. This is where you start losing money. Anything in between until expiration, because in between, options go up and down like crazy. If the underlying moves like crazy, you stay calm. Unless you make money, you want to go away. But when you stay calm, the 75% overextension of volatility will come to its senses, and then go back to where the historical volatility levels are. And then in these 2 out of 10 scenarios that it will persist below 70 or 85, there are strict rules. So yes, we've got stop loss, but this is like the last resort for us, Thiru, because options, you can roll them in time, you can roll them in strike price, and then you can protect yourself at some point. If it wasn't the strangle here, for example, I would wait convincingly for something to breach either the 70 or the 68 or the 86. Anything in between, I wouldn't do anything. Now, if that happens in 2 days, there are things you can do, like, yes, I was so wrong and that thing goes south, then I will be making money from the call option that I short, and then I will be losing money from the short put option that I have. So what do? I go back and sell another round of call options, right? Now, it might be difficult to grasp at the beginning, but what I'm doing is like taking more premium and slowing the trade down. So while this thing here that I sold is losing money fast, this thing here has given me 1 round of premium. Then I go again and I sell another round of premium by taking premium with strike prices like that. And so I give the trade some room to breathe. And if that trade continues to go south, then I can take that and move it to another month. And if I'm so bad luck, and it only happened once in 2024, for example, when X was bought out, United Steel was bought out by a company, and it jumped from $25 to $52 overnight. So this is your black swan event. You can't do anything about it. You have your stop loss that goes to 7% of your account in total from a single trade. So if I'm trading 70,000, I would not be willing to lose more than 5K on a single trade.
Right.
Now, the key here is, how often does it happen? Once, perhaps every 200 trades, once every year, right? So you are betting on making a lot of money, a little bit of money, many, many times, with the statistical edge on your side. And there are 3 ways, which are a little bit more technical to explain in detail here, but you will roll in time, you will roll in strike price, and you would have the ability to take protection at some point. Eventually, the 7% threshold should be your last resort there.
Interesting. One thing I really like, and I think you have mentioned it quite a few times, Yannis, is the options trader, before he even gets in, all the probabilities are quite mapped out, and it's all pre-built into your trade position in your strategy, which is really good. And you're already pre-anticipating the worst case scenarios and what to do then. And also you got the maximum amount of loss that you will ever take, even if you did get to the outlier position. So far, am I right in that summary?
Yes. I mean, it's such a fantastic world, Thiru. Now, for people who don't trade options or don't know about options, I think most important today would be to understand, hey, this is a fantastic new world where I don't have to be thinking what to buy. And I can make sort of passive income because I'm selling the dream to other people who want to buy it. I can play it smart, safe, and then still be able to speculate in a healthy way in the market. But yes, everything you mentioned is correct. And I would add that there are 56 different ways of thinking how to make money in this market, but you don't have to. I mean, I have a method that I've been following, and I'm using, like I told you, 5 or 6 strategies, a little bit more complicated stuff, but the majority is like, keep it simple, stupid. Okay. You sell your volatility, you've got your stop losses, your edges, you've got your statistical edge, and then it's the large numbers. Do your trades, follow your method, and then that comes into place. And that's what we teach when we do options. Now, there will be time where, like the SLV, you've got your mega cycle in commodities, and then selling premiums. It's okay, you make money, and long term, that's a very juicy part of your portfolio. At some point, you'd like to speculate, and then that's what we did with the SLV. So if you allow me, that was a little bit of a chart idea, but I thought SLV as a silver is going up when rates go down, typically, when the Fed lowers rates, right? And then obviously you would expect the dollar to go down because the Fed lowered rates, but the dollar went up. So that wasn't like typical. But when you have a channel here and then you've got to break out of the channel, simple one-on-one technical analysis, you've got your retest here. It didn't go into the channel, and then bam. And then that point here, around here, you buy a position where you say, I'm spending multiples of $200, and then I've got 1 to 4 or to 3 risk reward ratio. So for every $200 you risk, and that's your maximum risk, you are set to make $600. Effectively, with the 6% that it made yesterday and today, we sold all our positions with a little bit more than 140%. We don't want to get greedy, right? So these are the trades that options can give you that go beyond average thinking that an average trader watching CNBC or Bloomberg, not your channel, because obviously you are teaching fantastic things. Your system works great. I've tested it. We've seen it together. But the average person will listen to his uncle, who listens to his friend. He will go on Bloomberg and CNBC and try his technical analysis and then make a decision. This is what we want to avoid. These people will be losing money in the markets. We want to make money by taking advantage of what other people don't know about options.
I really like it, Yannis, because there are different parts here, isn't it? So when it's stuck in the channel, to capture the volatility, you're then earning the premium. Indeed. And then when it breaks out of a channel like that on a retest, when there's move on the upside, you imply another strategy. It's really good, and it's all pre-calculated before as well. I just got a few more questions before we end off. I know the time is coming quite near as well. I'm quite aware of time. One last thing on risk management. If I would say there is one trade that taught you the biggest lesson, what would something come to your memory?
Listen, we take out COVID because everyone was hurt during COVID, whatever you did. The key thing is like to go back into the game after COVID settled down. Actually, COVID short term was bad for us, but medium term was very good because we were using options to hold our portfolios and get our exposure. So the Black Swan has always been an event that, a big lesson for me. Why? Because the Black Swan event will come out of the blue, as you know, and it will be in the form of like the -7. Now in August, it wasn't that, but back in 2002, it was. So you've got the broad movements that take you out of these channels. And then when you bet the things stay within the channel, you get out of the channel straight away and you don't have the time to hedge, right? And that's where you leave things entirely unhedged, which is what I don't do. Since then, of course, you leave it unhedged, and then despite 8 out of 10 times making money because of the mean reversion, the black swan will make your gut very, very tight. You will be losing money. You can't avoid it. Now, if you got the stomach to cling on it, then you will be making back that money. Like Nick Leeson, he brought Barings down to its knees because of that. He was trading the same strategies, my friend, when the Kobe earthquake hit in 1987 in Japan. And he actually went into creating that phony account where he was placing only his gains. And then the phony account had the losses and the normal account had the gains. The guys in London thought we have a star trading, and the other guy was bringing the bank to its knees. So that's what happens when you sell volatility, you don't hedge. So that bad trade cost me a lot. It took me about 6 months to recover. And then ever since, I'm like that part of the position, right? And ever since, when you sell volatility, you want, like I say, when you buy something, you have to sell something. So despite the statistical edge and everything in between, you don't want the black swan, which are more often than ever, more frequent than ever. You don't want a black swan to take 6 months of your life trying to get your money back. I did because, using options and leverage, it was easy. For other people, it might be 5 years. So I do not do that. I do not teach that. And I always like to buy something when I sell something that will definitely make less money to be made on all these 8 trades, but never lose more than a certain quantity that you preset on a very, very bad day. And we do have very, very bad days occasionally lately. Call it war, inflation, power, or calamities.
But very good. I think the main thing what you're really doing there is you are just limiting your risk, which is important because it keeps you in the game in the long run. And the interesting thing that nicely you shared as well, which is, even though you made that loss, but you came back 6 months into it, that shows really your conviction in your system. And when we publish our results live, I mean, we've got so many scenarios like that where, we're almost breaking even or going into drawdown for 3 months, but because we know that the edge is there, which is what you've clearly defined as well, you finally come out of it. And incredible. It's nice to see that conviction in your system. Thanks for sharing that. One last, so we go into the last part in terms of exits. So that's quite a vast topic. But if you can tell us maybe just in a few lines and in a summary, which is, I mean, just like in directional trading, but it doesn't look like it, I think, in options, where do you have like a predefined target, or is it basically based on time-based exits, or is it different strategies will differ where you will have some targets to come out? So how does that work? If you can go through that.
So you mentioned defined trade. So there are 2 different things. One is the defined risk trade, and the other is the undefined risk. So one strategy, I know what I'm risking, and the risk reward ratio is very high. So I'm risking 2 for making 4. So there you are. I've got my target. On the SLV trade, for example.
Okay.
So when we entered, it will not show now, but we entered on the 15th of November, so regular, like I sell. And at the time, it was trading about $28, $27.80. So we chose the 29 strike. And so you buy the 29 strike and you sell the 32 strike. That creates something that we call a bull call spread. It doesn't matter what it's called, but you will see the graph here. And that is, okay, I'm risking $200. That's what it was. And I was making the potential of making 4 times my money. How do I know that? Well, you measure the difference between the 2 strikes. So $3 minus what I will pay. So that's the graph. What did I pay? So I was paying, I'm sorry, not $200, $70. So that was 70 cents. So my break-even point is 32.70 or 29.70, I'm sorry. So the maximum I can make is 29.7 up to 32. How much is that? $2.3. How much am I risking? 7. What is the risk reward ratio? 3.5. Yeah, in that example. So that's my target value. Now, I just told you I sold everything when it came to 140%. That's fine, because you can see SLV is -2 today. Why did I sell? First of all, you don't want to see a very good trade going very bad at some point, right? And I'm always thinking in terms of graph, and I'm a lousy technical analysis guy, and I know very few things about it. But one thing that I know is when you get aggressive moves either to the upside or the downside, and I mean moves that bring you to about 90% degrees, like so it's a vertical increase, at some point the market will bring it back to its mean, or will bring it back to normal levels. And the normal level is back to where it started at +6, right? If it doesn't go here and it goes here, still my option would be losing 50%. So from 150 or 180 that I sold, we'll go back to 1. I might buy back. But if it doesn't move quickly, I don't want to get greedy, because I sold this thing and eventually would have to go back. So we sold the positions, but the answer is the risk reward for defined risk is 1 to perhaps to 3 or 4 or 2.5. I don't get all the position. I don't stay that long in the position, but I would try to get 100% plus on these trades. On the other hand, if I do my XRTs, like I said here, and selling volatility, so, betting, if I can use these words, but we don't bet, that the market or XRT will stay between the price. And now, for example, I think I short the 85, and then I short the 70, the 68, let's call it like that. Okay, we'll still give you the graph without pricing. So that's the graph of a short triangle. This is the profit probability you see, even though I don't have prices here, the market just opened. So I've got 80% probability to make $68 and lose indefinitely. This is what scares people through. The maximum loss. They see the infinite symbol here and they scare a lot themselves. But it's not like that, because you've got statistics on your side. And you can protect straight away if you see that things go bad, and you never get into the position of losing that because you've got your stop loss. But where I would exit here is where I would be making about 50 or 60% of my money. So 50 or 60% of $68. Now, this example is not a real example. I didn't study to give you that. Normally, I would do something that takes up 20% on my margin. So if there is a margin of $1,000, I would be looking to get at about $180 of premium. That represents 18% return on investment, because my investment is the margin I secured for that. Yeah. So if I'm aiming for $180 or for 70 here, when that makes half, I go. Why do I go? Because I don't know if something goes, for example, if I go to XRT, I don't know if I make my money because XRT went here and then pop, all of a sudden spikes, goes above this resistance line, and then goodbye gains. And then I'm started losing money. Why do that? So I want to make 50% and go away. But having said that, 7 out of 10 times, if I keep my positions going on, because they have exhausted all the movement, I make 100% of my position. The thing is, the 3 ones have gone way wrong after I sold for profit, and it would have hurt my portfolio. So statistics in this strategy is like, get your 50% and go away, because we're talking about 50% within 3 weeks or 2.5 weeks. Now, imagine, we're not making every time 50%. You've got your 20% losses, right? And that equates to an annual percentage. But a long story short, risk reward on a defined risk, 1 to 3, go out above 100%. Selling volatility, about 50%. If I make 30% and I can see that things are starting to change, I'll still take my 30% and run. That's
very
fine.
good. Yes, yeah. It's nice that it's all predefined right from the beginning, So it gives really the good clarity for the trader. I really like that. I mean, just a very small question on the exits. I mean, now knowing all of this, so you got all your stats in place when you enter and you exit, you got all your probability stats. That's really good. And also how the way you define that, when people see the infinite loss, people get scared. And that's why the importance of a mentor and all of that. So you know all of this. So would you say, and I read this in one of the market business book, would you say that when you exit most of your trades, Yannis, whether it's profit, loss, or you took the premium, whatever it is, would you say that you feel at peace when you exit most of your trades? Or do you sometimes feel a bit like, oh, maybe I could have taken a bit more, I could have stayed in that trade a bit more longer? Those kind of thoughts come, or you absolutely at peace nowadays?
Cold-blooded, my friend. I can't be where I am thinking about these things. If it's 50%, I go away. If it's 100%, you know what I would do? Let's take a sample of 100 trades. How many times have they gone to 100% for me? And how many times have they gone back to, effectively losing money on me had I not closed them? Is what I told you. That 3 out of 10 that went against me after I closed for profit sucks. I don't want it in my life. So I'm ready to denounce on the rest of the profits, leave to trade another day, trade, cleans, repeat, trade, cleans, repeat. That's what it is all about it. And then you've got a method and you go around and then you tipping some other things that you learn as you go along on this journey. And no, I don't have any second thoughts. I would have had second thoughts if I hadn't have a method to follow. But everything today is all about a method, clear cut, to the point,
Correct.
exit, maintain, risk manage, and how much money you will be making. So, no regrets.
It's great, because I think all professional traders, we all start to sing from the same hymn from the music book, isn't it? Because I think the principles are all the same. But once you are stuck with your methodology and you know why it works and you know and believe in your edge, then there's no second thoughts. When you come out, you're at peace. But to get to there is a journey, and I think having a good mentor on your side will definitely help. I mean, the last question I would say, I know you did mention about the black swan trade, and then it took you 6 months to come back. I mean, you must have some resilience in that and some belief in your strategy and in your numbers to do that. So in terms of psychology basis, I mean, do you do kind of like, do you have a routine, like a pre and a post trading routine? I know some traders, investors are very big in meditation and in balancing their left and right brain, as Ray Dalio always says, the biggest hedge fund manager out there. So like that, did you have some kind of a trading routine to work on your mind and your psychology to build that resilience in and to keep your consistency?
Yeah, I do CrossFit and yoga, my friend.
Oh,
I know, because it helps exactly towards that. So I exercise every single day except for weekends. That keeps your mind, weight, your dopamine and serotonin and all these good substances that your brain and mind give you when you exercise. These are all stimulants for having a good trade and have a clear mind. You have to keep your testosterone up. That's true. You can walk 10 miles. That's pretty much the same result. But yes, you exercise and you have that. I don't meditate. I don't think the average person would meditate. So I'd like to give people something that I can apply themselves. They can go to the gym. They can do 5 miles walking, right? They can read the press and they can have some basic knowledge or extensive knowledge like I do in my seminar, and then go into the field and try them out. So the preparation is like, listen, if I have my method and if I know that I'm selling high volatility trades and I know that I go one standard deviation away, I know how to manage. I know how much money I have. I know how many contracts I will trade because I'm a discipline. And I know where I will exit and what happens 8 out of 10 times. I don't see, why you would be shaking when things go bad or the statistics. So being prepared is, don't overdo it with over leverage and over trading, or you make 20% and you go away. No, stick to your 50%. Yeah, because that's your target. And the routine, it's, food plays a big role. But, if you exercise and go 5 days to the gym and it's a quality exercise, then obviously your dietary habits will also be good. I read a lot because I once told a friend of mine, if you want to be successful in your life, go to the opera or go to a jazz concert. And the guy was a doctor. I'm like, why do you say that? Because you get away from everything that is your routine. And this is where all the brainstorming and the ideas come in the clear mind. So go to the opera is my advice.
I like that. That's for something very different. It's true because when you do something very totally different, that's when I think it's the alpha or the beta waves start to get activated, and then you start to get ideas that you're not able to do when you're so into the thing itself. Yannis, thank you so much for sharing that. I know we're coming near to the time. If anybody has got any last questions, you can type it into the chat box. I've got a speed round over here that we will do. So in that speed round, before we go into where can people find out more about you, um, I'll just say a word, and then if in just one or two lines, you can just tell us what you feel about that word. So for example, if I were to say the word loss, what would you say about it?
The word loss.
Yeah, LOSS. Yeah.
I mean, they are part of the game. That's what I would say. So don't be afraid of losses, Tito, because that's why people lose, because they think they will never lose in the market. But that's the first thing they have to realize. Loss is part of the game.
Nice. And then if I were to say the opposite, success, what does success mean to you?
For me, it's not only money, Tito. You know, you have to have a balance in your life. So if I have millions and I have to spend 5 hours on the screen, I don't want it. You know, it might sound silly, but you have to be able to enjoy your life and spend the money with your loved ones. I don't think I can do that at my age, 5 or 8 hours on the screen. So success is like finishing the day and thinking, I've made something good in my life. I've learned something more, and I have seen and I've made the bed for my kids. So I'm not missing out on these opportunities when they grow old.
Beautiful. Yeah, I like that. And the final one, age.
Edge, well, we are option traders, so we have to play with statistical edge, right? So I'd like to be the casino. A client of mine say, like, you like so much casinos, why don't you open one? You can do one online. So I wish I could do it. But yeah, edge is all about trading. And once you have your edge and you identify, and that's what options actually, and everything that I explained today do, then it becomes stretch free. It becomes something like, over and over again, and that's a numbers game. So edge
Beautiful.
is everything.
Finally, Yanis, that was really great. I really, really enjoyed that session. Now, where can people find out more about you? So let me just share my screen over here. And as you're telling me that, I think for those of you who are already in the Zoom session, you also get our 7 steps to CTP video course as well, totally free. You can see how that correlates with the option site that Yannis is talking about. I think also Karen is showing that on the screen at the moment right now. Is that the right place to find out more about you, Yannis?
Yeah, well, I've been sharing a little bit. It's icandargis.com. That's my website. Now, it's one thing. It's my YouTube channel, Facebook, and Instagram. I post many things in Greek and Spanish, and they're quite valuable things. Now, expanding into the English-speaking world, well, I will be doing more and more things in English. So yes, my YouTube channels and Facebook and Instagram is ioannis.kandargis. But if someone wants to learn more about me, that's the English version of my webpage. So i.kandargis, and then you can find out about my experience and how I looked younger and where I have worked, things like that, and leave me a message. I will be doing seminars in English. I just finished one 3 weeks ago, and I will be doing another one after I finish my Spanish one, which starts in 3 weeks. So keeping in touch would be great. And I will be posting some interesting English material on there. I will be in London on the finance matinees for people who are in London on the 19th. I will be doing a panel moderation. That's at Bill & Gates, Old Bill & Gates Market on the 19th of November. And yeah, the best way to keep in touch is through the webpage and my social media, I guess.
Great, Yanis. Thank you so much for your time today. Really enjoyed this. I'm sure the viewers enjoyed it as well. This will be on YouTube. I will also share the link out to our people in our database, and I will share that with you, and you can share that with your followers as well.
Oh, sure.
And thanks once again for coming on. It's such a pleasure. And As we always say, traders, till the next time, stay disciplined, follow your trading plan, and keep trading like a master. Thank you and bye for now.
Thank you very much, Thiru.